Respected Central Council Member, C.A. Purushottam Khandelwal, Vice Chairperson of Committee for Members in Industries, our learned speaker, C.A. Chintan Patel, sir. A very good morning to all of you. As a mark of protocol, we'll start with the ICI motto. Can we have ICI motto, please?
So please go ahead, sir, without motto.
Okay. I will request Central Council Member C.A. Purushottam Khandelwal, sir, for his opening words of wisdom and opening remarks.
Good morning. Chairman of the Committee for Member in Practice in absentia because they are in the USA, C.A. Prakash Sharma ji. Learned faculty and dear friend Regional Council Member Chintan Bhai Patel. Secretary of the Ahmedabad branch and coordinator of this program Neerav Agrawal. Rishabh Shah. Secretary of this committee Rajnikant ji, Priyanshu Malhotra, and all respected chartered accountants. I welcome all of in these programs organized by the Committee for Member in Practice, one of the important committee which is given chairmanship is given to Prakash Sharma ji, and I am working as a vice chairman of this committee. This is a very close link between the member, those who are in practice, and the institute. And our intention is to equip the members for face the challenges. We have to the mission of ICI is in the develop skill and professional with the competence to serve the client not only in the within India but the globe. So how to serve better to the stakeholder? We are here to equip our members. We have lot of programs we will organize for the members. We are also providing audit tools for the members to equip to perform better. We are running a certificate course for the members. Now these are 3 courses: wealth and financial management, drafting of appeals, pleadings, and how to appear before the authority. And third one is certified course for the management of working paper. So our intention to how to equip members, because all the stakeholders looking at the member who sign the financial statement, and as a regulator, our intention to perform well. मतलब those stakeholders believe on us, जो हमारे पे विश्वास करते, जो stakeholder, whether bankers or governments or a tax authorities or a shareholders, we have to prove our best, because now in the changing scenario, the after the amendment of this chartered accountant bills, the responsibility is much higher than what we enjoyed previously. Because in this scenario, if the partners of the firm do something wrong, the firm as a whole will be the responsible. So it's not only your responsibility to look into how to perform, but you have to look as a firm as a whole. Now the disciplinary committee will be headed by non-chartered accountant. So the presiding officer will be the non-CA. This is the major amendment passed by the Lok Sabha and Rajya Sabha. So my humble request, all the members, our committee with the team members is here to serve you better. If you have any suggestion, free to call at any time to me or my committee secretary Rajnikant ji is there. We running lot of beneficiary scheme for the members, employees, and the students. Whether the insurance benefits or a software, there is a discounted price for the software. So we will do our best to serve the members. With this opening remarks, I hand over charge to the Neerav Agrawal, Secretary of the Ahmedabad branch, to take it as further. Thank you so much. Neerav bhai.
Thank you, Purushottam sir, for your kind words of wisdom. Now it's my honor and privilege to introduce our learned faculty for the first session, C.A. Chintan Patel sir. Sir is FCA, CPE, CS, Certified IFRS, DISA and CISA qualified. Sir is Regional Council Member of WRC of ICI for the term 2022 to 25. Sir was the past chairman of Ahmedabad branch of WRC of ICAI for the year 2017-18. It was during his tenureship, Ahmedabad branch has won 4 awards, 2 at national level and 2 at regional level. Sir is co-author of book on Quick Guide to Ind AS and ICDS published by Taxman. Sir is also contributor to Android application, accounting, auditing, revenue. Sir is practicing chartered accountant who is having more than 18 years of his rich experience. Sir is mentor and editor of Knowledge Update channel on YouTube. He is regular speaker and trainer at various forums with more than 300 presentations at various seminars in India, Dubai, Muscat, Sala, etc. Sir has published articles in ICI journals, newsletter. He is also chairman of Accounting Standards, Ind AS and IFRS Committee of WRC of ICI for the year 2021. Sir has a rich experience on Ind AS, International Gap Conversion, Companies Act 2013, Risk Advisory and GST. With this brief introduction of Sir, I welcome Chintan Sir to the session and I request Sir to please take the charge and take the session ahead. Chintan Sir,
thank you so much, Nirav, my dear friend at Ahmedabad. It's always pride pleasure when the Purushottam Khandelwal invites me at the seminar sessions, and it's always pleasure to work under him at various functions and various seminars for ICI. Chairman of the Committee of Members in Practice, C. Prakash Sharma ji in absentia, the Vice Chairperson of the committee, that is Committee of Members in Practice, the coordinator, Rushabh Shah, the coordinator, Secretary of the Committee, Rajnikant Shah, Rajnikant ji, Priyanshu and others. Good morning, all of you. I think the chairman, the vice chairman of the committee has already set the tone, and in his opening remarks, he has made reference to the recent changes in the disciplinary committee mechanism. I think that is something which we all have to be worried about. And the today's topic, which the vice chairman and chairman has kept for the committee, is really very interesting and eye-opener. Why is eye-opening? Because when you look at the changes in the Schedule 3 and also the changes in the CARO, it really provides us that a lot of things need to be really seen and checked by the auditors in this area. Let me share my presentation and then we can discuss about the changes which are there in CARO. Yeah, Nirav, my presentation is visible? Okay, fine.
Yes, sir, visible, sir.
Right. So basically, if we just look at the CARO 2020 and the Schedule 3, these both need to be really understood together because the CARO 2020 was first notified by notification dated 25th February 2020. So 2020, February 20 was the date when the CARO was notified, which is effective from financial year 1920. That was not possible. The kind of changes which are being done, that was not possible for the companies and the auditors to comply with this requirement so fast. Later on, in March 20, on 24th March 2020, the CARO was deferred to be effective from 1st April 2020. When you look at the various changes which are being proposed in the CARO 2020, the changes are where the lot of responsibility has been increased on the auditor's shoulder. However, there was no corresponding change in the Schedule 3. So it was certain that the Schedule 3 was about to be changed, and the Schedule 3 was very changed. That was effective from 1st April 20. Later on, both Schedule 3 and CARO, they have been deferred to be effective from 1st April 21. That is financial year 2021-22. That is the first year where we need to really look at the both important changes, that is the changes in Schedule 3 and changes in CARO. If I just look at the changes in Schedule 3, these are the biggest number of changes since the introduction of the Schedule 3, that is Companies Act 2013. So since last 7 years, if I look at one of the most important changes which affects the financial statements of the company, that is the changes in Schedule 3. And the responsibility which has been enhanced dramatically over the period on the auditors. The government believes, and government also accept the point that the auditor is a first external line of defense. If something need to be seen, if something has been aware about the auditor, that is the first one is auditor known as, because the management and directors are closely involved into business. We just think from external line of defense, who may be the first person to know about anything and who are required to highlight, who are required to alert to other stakeholders is auditors. So the responsibility of the auditor has been increased. And if I go through various changes, amendments throughout the sessions, you will realize that the changes are introduced because of recent fraud, recent scams that happens, and increase in the expectations of the government at various stakeholders. Let us first understand about the changes as far as applicability is concerned. So as far as applicability of CARO is concerned, there is no change, right? So as far as the CARO applicability is concerned, there is no change. The exemption which is applicable to the small company, which is applicable to one-person company, they are still applicable. So there is no need to be worried about as applicability of the is concerned. As far as private limited company is concerned, the applicability remains as it was earlier: paid up capital plus reserve surplus of up to 1 crore plus borrowing up to 1 crore, and revenue is up to 10 crore rupees. If all these three conditions are fulfilled, then it is not applicable to private limited company, which is not a subsidiary or holding of a public company. So as far as applicability of CARO is concerned, no need to worry about, and then you can go through whatever you have done last time if there is no change in the this criteria which has been there for applicability. Now let us look at the reconciliation. See, I'm using the word reconciliation because we all know that reconciliation something is a very close word. Which is close to the heart of the CAs, because we're doing reconciliation everywhere. There's income tax, GST, and also at other things. So CARO 2016 versus CARO 2020. Now let us look at the number of amendments which are done. In CARO 2016, there were 16 clauses. These 16 clauses are now changed to 21 clauses. There is increase. So the number of responsibility of the auditor has been increased as far as the number of clauses is concerned. We may see just around 5 clauses are changed, increase. But however, that is not the fact. The fact is that there are more number of sub clauses are added. If you just look at the number of clauses, 16 is increased to 21, but there are various changes which are being introduced by way of increasing sub clauses. And also there are changes where there are certain amendments have been done in the word, or like deep deposit. There is one word which has been added in the deposit requirement with the word deep deposit. Now we all are aware that the deep deposit has been one of the most crucial point. In certain cases where the deposit is not being taken by the company, but it may be deemed deposit. So here the auditor is required to look at compliance of deemed deposit also. So there are changes in modifications, grouping, regrouping. 16 clauses are increased to 21 clauses. Sub clauses, there are 10 sub clauses. Now these 10 sub clauses are increased to 28 sub clauses. There are grouping, regrouping, which is also done here, where there are 5 are modified, so 5 comprises 5, 4 are being regrouped. So if you just look at in totality, there is a manifold increase as far as the clause and sub clause is concerned. When I just talk about manifold increase, I think that means there is increased responsibility and extent of level of checking need to be also increased. Let us look at now the overall summary of the all clauses. What I have tried to cover in the short period of 50 minutes is that I'm going to focus more on the changes and amendments. CARO 2016, we all have been applying for since last many years. So as far as CARO 2016 is concerned, this all has been already being taken into consideration. As far as CARO 2020 is concerned, my focus primarily is to touch upon the few important changes which we all should be aware about. And I think this is a time, if it is not been started, I think this is a time for all of us to really work upon the changes, have a planning to ensure that our audit team is also be aware about these changes. Let us look at this requirement. If you just look at here, the new, any clauses which are added new, I have marked as a new. Wherever there is a modification in the clause, it is mean with this particular things. And where there is no change, the clause remains same. They are marked with this particular this particular sign. So if you just look at here, the intangible assets records, it has been added as a new clause. There is a little bit modification in the title deeds improvements, new requirements of binary property and property, plant equipment, intangible assets in revaluation. Then there is a very important, and we are going to focus more on this particular part, which is a very important critical part. Working capital loan, if it isn't taken on the security of current assets, there is increased responsibility on the auditor and also management. Then there is a requirement to provide disclosures as far as this is concerned on investment guarantee loan security advice is concerned. Then there are a very important change is on evergreening of loan. This is just a summary, or I think nomenclature which are this short summarized by me to understand, and we can look at the changes later on. But evergreening of loan, the word which has been coined and used recently at IL&FS case at various levels. So there is a requirement at this level to look at evergreening of loan. Then loans and advice is given, details of terms not stipulated. So these are the two new amendments. Then comes compliance of deposit, deep deposit. I think we'll discuss about this particular concept later on when we talk about this. Then earlier there was a need to only look at the compliance of deposit. Deep deposit was nowhere under the requirement of the auditors to check and look at compliances. Now there is a specific requirement. Then there is a accounting for surrender of undisclosed income. There is some change in a default and repayment of loan interest. Willful defaulter has been added here. Then there are a few requirements with respect to this new are on use of loan, which we are going to discuss later on. Then next come is on fraud reporting. There is one change where the fraud reporting by auditor was being added here. Whistleblower complaint, default in interest repayment by Nidhi company, internal audit system, report of internal auditor. There is a specific focus on this requirement in this new CARO 2023. Then there are a few changes which are talking about NBFC and core investment company. Cash loss is a new requirement. Auditor resignation is a new requirement. Meeting of current financial liabilities, CSR obligation. And lastly, also in consolidated financial statements, there is a need to give the details of qualification or adverse remarks by competent auditors. I think these are the few things which we all have to be worried. And now what I have done is that I have classified amendments into 4 parts. The objective of classifying 4 parts is to really understand the amendments from the reasoning point of view. One. Second thing, the grouping is done so that we are able to digest the changes very fast. Because when the number of changes is very high, it will be very difficult to understand and digest the changes by us. So that's why I've tried to divide to the 4 parts. First is that what are changes which are done, which is correspondingly changes to Schedule 3. As we all are aware that Schedule 3 financial statement is a responsibility of the management. Management has to prepare and presentation of financial statements as a Schedule 3 is concerned. Even in the auditor's report, there is a separate mention that it is primary responsibility lies with the management. So there are a few changes which are being aligned with the changes in Schedule 3. So that we are going to focus, discuss first. Then there are the changes where the focus of the government was to control the fund. A lot of things on the loan, advances, investments, and the responsibility of the auditor to cross-check and verify the funds related movements. Then comes the control enhancements. And there are a few changes where they want to focus on control. Let's have more control over the operations of company, and that's why these are changes. And there are a few very small changes on a specific regulation, that is on NBFC and CIC. Let us look at now the first very important part, that is Schedule 3 amendments. There are 10 important amendments which are being done in CARO 2020. They are corresponding to the Schedule 3 amendments. First one is on title deeds of immovable properties. Then there are all revaluations, benefit property, loan, working capital loan, accounting of undisclosed income surrendered, promoters, RPs, willful defaulters, use of short-term fund, meeting of current liabilities, CSR. So, as I mentioned it, I'm again repeating for the purpose of understanding that these grouping of changes are also made in Schedule 3. So, if you just look at, if you want to really look at the compliance of these particular things, we can also verify the disclosure which is done by management in the Schedule 3. So, our responsibility is on review of the disclosures, review on what is been disclosed, is it been correct or not by the management in this Schedule 3. Also, we should have the documentation available to suggest that the adequate procedure has been done by us. Let us first look at the changes on title deeds of immovable property. There is a little bit change, which is more clarification nature. But it's been said that whether the title deeds of immovable properties other than properties where the company is the lessee. See the word, the font blue, the paragraph which is in font blue color, it is a change. Black is some font where it is already there. The change is being done by way of the blue font. So it was a modified. It's not something which has been completely new. It was already there in a CARO 2016. Now what it says that other than properties where company is the lessee, there was a dispute, there's no doubt as far as the lessee is concerned. And it now says that as far as it's the lessee, or basically it is being that the lease agreement is there, then you can just look at the lease agreement. There's no need to worry about the title deeds. So other than properties where the company is lessee and as disclosed in the financial statements, I think this word which we need to be again seen here. Why? Because the primary responsibility is on the management. The title deeds of immovable properties, whether they are in the name of the company or not, they were already requirement of the CARO 2016. However, in CARO 2020 or in Schedule 3 revised, the management is required to comment and disclose if any land and building, if the title deeds are not in the name of the company, they are required to provide disclosure in Schedule 3 that yes, this is the land which is in the which is in the line item of land and building of property plant equipment. It is not in the name of the company. What is the reason behind this? In whose name it is? That also need to disclose by the management in the financial statements. So now it is clearly said as disclosed in the financial statements. So I think then our responsibility is to whatever is been disclosed by the basically by the management, and then we need to see that are they in the name of the company or not. Then we need to also provide the details thereof. Now coming to the next part, there is a PP revaluation. So here it says that where the company is revalued, AS 10 property plant equipment and India 16, they both talks about the property plant equipment accounting. There are two models. One is cost model, second is revaluation model. Under revaluation model, if the company has adopted revaluation model and if the company has done revaluation, under this Schedule 3 and also under CARO, there is a responsibility which has been casted upon the auditors to see that if the revaluation is done, then whether the revaluation is done by a registered valuer, that is point number one. Second very important thing is that if there is a change, and if the change is 10% more, then it has to be disclosed separately. So this is applicable to in both case of property management, also intangible assets. So if the company is revalued PPE or intangible assets, including right to use as assets during the period, then whether revaluation is done by registered valuer, and what is the percentage change if the change is more than 10%. Next part, that is on Benami property. The Benami property laws is again a very complicated and very important law is concerned. However, even after the Benami property has been amended recently, there is no specific requirement to disclose in financial statements. However, at a Schedule 3 revision, this is need to be disclosed in Schedule 3 financial statements, and the CARO auditor, there is responsible on the auditor to look at and check, okay, is there any proceeding has been initiated or pending against the company for holding any Benami property. So even though any proceeding has been initiated where the company has received a certain letter where the proceeding has been initiated under Benami Prohibition Act, or it is already going on, it's a pending, then it is a very important responsibility as far as the audit is concerned, because the stakeholders need to understand that this kind of proceeding is been going on against the company, and that is to be disclosed by the management and also to be checked, verified, and confirmed by the auditor in the CARO reporting. Next point is that whether during any point of time of the year the company has been sanctioned working capital in excess of rupees 5 crore. I think this point requires a little bit more attention, because this may have a huge implications as far as certain companies are concerned. The focus and objective of the government was that whenever some documentation has been provided, it should be exactly as per books of accounts. Now, in working capital, the limit is decided, limit or drawing power is decided based on the statement provided by the company. So the information that is provided by the company is very critical, and if the default happens, in many cases it was noticed that the statement that is provided by the company and the books of accounts are not in match. And the drawing power is something which is very critical for the bank, based on which they decide that what is the amount to be available for the purpose of the fund utilization for the company. Now, in that case, basically, whether during any point of time here the company has been sanctioned working capital limit in excess of rupees 5 crore. The point is in excess of rupees 5 crore. As a Schedule 3 is concerned, Schedule 3 is not talking about the limit of 5 crore rupees. Schedule 3 basically is just talking about every case. So wherever any working capital limit has been sanctioned, the Schedule 3 requires to provide disclosures. However, as far as the CARO is concerned, it says that the responsibility of the auditor is only in case where the sanction limit is more than rupees 5 crore. Right. So basically, here it says that the bank or financial institutions on the basis of secured of current assets, whether quarterly returns or a statement filed by the company with such bank or financial institutions are in agreement with the books of accounts. If not in agreement with the books of accounts. So here it says that whether during any point of time the company has been sanctioned working capital limit in excess of rupees 5 crore in aggregate from banks or financial institutions on the basis of security of current assets, whether the quarterly returns or statements filed by the company with such bank or financial institutions are in agreement with the books of accounts of the company, if not, give details. So I think here the point is that first, if it is in excess of rupees 5 crore in aggregate from bank or financial institutions, from bank or institutions on the basis of secured current assets, whether the quarterly returns or statement filed by the company with such or bank finance institutions are in agreement with the banks of accounts. So let me just first look at this. question, if a working capital loan sanctioned on the basis other than current assets, I think as I mentioned that this is requirement is only on the basis of security of current assets, right? So in case if the working capital loan or if the amount is being sanctioned for other than current assets, that is not covered here, right? So this is only specifically for the purpose of the security of current assets. Second is whether sanction include renewals. Here the ICI is provided guidance note. My humble request to each one of you that please refer to the ICI guidance note, and ICI guidance note has provided a lot of disclosures, lot of clarification as far as every clause is concerned. What it mentioned that the sanction also includes renewal. So as far as the working capital loan is concerned, which has been provided on the basis of security of current assets, then that is being covered here. Right. Second is that if such loan sanction is more than rupees 5 crore, but you realize only rupees 1 crore, is it covered? So I think the word which has been very important thing is on a sanction limit. So what is more critical is not utilization. As far as it is being sanctioned, right? The word is a sanction. It is not of utilization. As far as it is sanctioned, which is in excess of rupees 5 crore, in that case, it is covered under this particular clause. Next point is that if the company is also submitting monthly returns, whether the same also needs to be verified by the auditor. Now, this has been one of the most important points because in certain cases, the banks requires to provide monthly statements, not a quarterly. Now, if a monthly statement is provided, the question is that whether the auditor is required to verify the monthly or quarterly, because there's no quarterly statement is there. So the ICI guidance note provides us a solution that if for example, if the client is submitting April month, May month, June month, July month, every monthly the return is submitted, then every quarter end, that is June quarter end, September quarter end, December quarter end, March quarter end. So every quarter end, whatever the amount or statement is submitted, that is to be checked. Even though that statement is of month June, but still it is submitted at the end of quarter. So at every June, September, December, March, whatever statement or return has been submitted by the company, that has to be verified. So as I mentioned here, that the responsibility is on the auditor. And what is the requirement? The requirement is that the statement which has been submitted, which includes stock statement, it can be a book date, or it can be any other arrangement or even aging also. So the word which is used that any statement or returns. So whatever has been submitted, that in that case, the auditor need to cross check the figures which have been submitted to the bank with the books of accounts, and then it need to provide that if it is not in agreement, it has to be provided. So in Schedule 3, the first responsibility is on the management. Management has to himself disclose, okay, I have not provided, which is in compliance with the books of accounts. In case if the management doesn't provide the correct thing, but still it is a responsibility on the auditor to cross check and then confirm that whether reporting to bank is in compliance with books of accounts or not. Next come surrender or disclosure of unrecorded income. So here the point is that if during the year there is a disclosure or surrender of unrecorded income, so there is a thing, this unrecorded income has been surrendered or disclosed during the year, then the responsibility is on the auditor to check is it appropriately recorded in the books of account or not. The appropriately recorded or accounting of these particular things need to be checked and verified by the auditor. Then comes loans or advances to promoters or related parties. Now, if you just look at this requirement, here the focus is primarily on providing the disclosure wherever the loans or advance has been given to promoters or related parties. And these loans or advances are which are repayable on demand or without specifying any terms or period of repayment. So here it says that only in case where the loans or advances has been given to promoters or related parties which are repayable on demand or without specifying any terms or period of repayment, then only these need to be disclosed separately, where one has to specify the aggregate amount, percentage thereof to the total loans granted, aggregate amount of loans granted to promoters related parties. So this is all disclosed by management. The auditor has to verify and check and confirm whether what is disclosed is correct or not. Now the next part, that is all willful defaulter. Whether the company is declared willful defaulter by any bank or financial institutions or other lender. So if that is the situation, because if any company has been declared willful defaulter and if the stakeholders are not aware, I think that is not something acceptable thing. So that's why it says that if somebody has been declared willful defaulter, then it has to be disclosed in financial statements, and auditor also has to check and confirm that whether it has been declared willful defaulter or not. So that is the responsibility on the auditor along with management. Next point is on short-term fund utilization for long-term. Whether fund raised on short-term basis have been utilized for long-term purpose. So if the company has taken a working capital loan and the working capital loan has been used for the purpose of the fixed assets capital work in progress or some other long-term basis investment by the company, I think that also need to be really checked and verified. And if that is so, that the nature and amount is to be indicated here. So this is basically on short-term fund utilization for long-term. Whether the fund raised on short-term have been raised for long-term purpose, nature and amount to be indicated. Next comes is a capacity of meeting current liability. On the basis of financial ratios, aging, and expected dates of realization of financial assets, you just look at the requirement. The requirement is that the auditor has to judge about capacity of the company of meeting its liability. I think this is something which is a more of like qualitative disclosures, where the auditor is required to judge the capacity of the company of meeting its liability. Which liabilities? Liabilities that are existing as of the reporting date. Right? Liability that is existing as on the reporting date, and then up to 1 year period. So from balance sheet date till 1 year period. So if my balance sheet date is 31st March 2022, so from March 2022 till March 23, whatever liability falls due based on my financial ratio, based on aging, based on expected date of realization of assets, payment of liabilities, auditor's knowledge of board of directors, management plan, I need to, as an auditor, I need to really approve my comment, that what is my quality comment, whether the company is capable of meeting its liability or not. So that is what is the increased responsibility as far as this is concerned. Then comes a CSR. The CSR has been one of the most important points for the government, and the government has made it, it is very clear that the fund, the purpose of having compulsory CSR obligation to ensure that it has been used for the end purpose. The poor, the beneficiary should get the benefit of the CSR provisioning. Now, this CARO requirement says that in case if the amount is unspent, now amount unspent can pertains to two things. One, it can pertains to the ongoing project, or it pertains to other than ongoing project. If it pertains to ongoing project, then as per subsection 5 of section 185, the company is required to transfer to a special account that is within 30 days of the end. So if a company intend to use the fund for a certain project is going on, So once the reporting date is over, then the company is required to transfer to a separate account for ongoing projects. Now, in case other than ongoing projects where there is no project is going on, however, this amount is unspent within a period of 6 months of the expired financial year, the company is required to transfer to a separate fund. So these responsibilities on the company, and the responsibility is on the auditor to cross check and verify that whether this is done or not done. Now coming to the next part, that is on the fund related amendments, basically where the focus is on the details of investments, guarantees, security, loans, advances given, investment guarantee security, evergreening of loan, compliance of deep deposit, default in repayment of loans interest to any lender, fund with respect to subsidiaries or joint ventures, and cash losses. So I think there are 7 points which are primarily focusing on the loan, advances, investments, funds, and where the government wanted to have the increased responsibility on the auditor to cross check and compliance. Let us look at first. The first point, the only change that is on, they've added investment and guarantee and security in this requirement, right? Earlier, it was recorded that wherever the company is made granted or loan advances, that was covered to be disclosed here. Now, in addition to the loans or advances, there is also need to look at the even investment is being provided, given, or guarantee or security is being provided. That also need to be covered as part of this disclosure concern or CARO audit verification concern. Now, what is need to disclose? In the same clause, it says that you to also disclose about what the outstanding amount and the amount during the year is to be classified into 2 parts. The amount with respect to subsidiary associate joint ventures or other than subsidiary joint venture associates. So I think the first point is that there is an increased responsibility to also look at and disclose about if any investment is also done, guarantees provided or securities given to companies, firms, LLP or any other party, then it has to be provided with classification into what subsidiary joint venture associate or other than that. Now the next point is that earlier there's requirement that whether the loans have been given, which is not prejudicial to the company interest. So I think earlier was that where the loans or advances, the nature of loans are not prejudicial to the company's interest. I think the focus was on what? That if any loan has been given by the company, the terms and conditions of the loan shall not be against the company. It shall not be prejudicial to the company's interest. Now that provision of loan has been expanded with respect to the investment, guarantee, and security. So all else remains same over here. Now comes very important point, that is evergreening of loan. Now I have used the word these in the initial part of my session where I mentioned that in case if the loans which are to be expired, which are to be repaid over the period, however, they are instead of repaying the loan, the fresh loan has been basically paid by the bank and the amount has been used for the purpose of a repayment of the existing loan. So just look at the kind of situations where the company is under obligation to repay certain loan during the period. Company doesn't have fund. So what the bank has given or what the company has done, company has taken another loan and then it was used only to repay the existing loan. So what is happening? It is just where the loan amount becomes big and the fund has not been used for the purpose of a company, but only for the purpose of repayment of the loan. So here the point is that the loans or advances in the nature loan which has fallen due during the year. So I think the company is under obligation to repay the loan during a period that has been renewed or extended or fresh loans granted to settle the overdues of existing loans. I think the focus is that the company doesn't have money to repay the existing loan, so they have taken a fresh loan, and that fresh loan has been used to settle the overdue of existing loan. In that case, you have to specify the aggregate amount of such dues renewed, extended. Then what is the percentage of to the aggregate of total loans that is need to be provided here as far as this loan is concerned. So I think the focus is and objective is to really have the clarity as far as the loan is concerned, whether how the fund of the loan has been used, whether it has been used only for the purpose of the repayment of the loan and not for the advancement, development, or growth of the business of the company. That is to be checked, verified by the auditor, and to be reported. Now, deposit compliance. Earlier under CARO, it was just mentioning one fact that the auditors are required to check whether the provisions of Companies Act 2013, right? Then directions of RBI, are they compliant or not compliant? So I think the focus earlier was compliance of the Companies Act 2013, compliance of RBI and other laws and regulations. Now, where the word was deposit. Now, what is done smartly? One small change is done, and they have added or here. And or it's an amount which are deemed to be deposit. What is being added here is the amount which are deemed to be deposit, right? So deemed deposit are also now required to be checked by the auditor with respect to compliance of the Companies Act or not. What is deemed deposit? For example, if the advance has been taken for the goods, supply of goods or services, as per Companies Act 2013 is concerned, it says that if the advance has been taken for supply of goods or services, if the period is up to 365 days, in such case it is an advance. However, it is beyond 365 days, then on the expiry of 15 days from the end of the period, it need to be repaid. However, if it is not repaid before expiry of 15 days, then it is treated as a deemed deposit. And if it is a deemed deposit, the company is required to look at compliance of all other deposit sections. Now, the auditor is required to really check on this deemed deposit requirement also, and that is what is very critical for various companies, small, medium, and large size companies. It comes where the company is defaulted in repayment of loans or other borrowing in the payment of interest thereon to any lender. And only one word which is changed is on bank or financial institutions. So bank or financial institutions has been replaced with a to any lender, and the only change is a to any lender. So that is need to be really seen here. So now it is not only limited to only bank and financial institutions, but however to any lender, all kinds of lenders have been covered here. And if there's a default in a repayment of to that lender, that it has to be provided details of lender-wise details in case of bank, financial institutions, and government only, and not in case of other lenders. However, so that is what is to provide lender-wise details in case of these things. Then next comes is basically fund, that is a subsidiary, associate, joint ventures. Whether the company has taken any fund from any entity or person on account of or to meet the obligation of its subsidiary, associate, joint ventures. If so, details thereof with the nature of such transactions and the amount in each case. Whether the company has raised, so I think there are 2 points which are there. Whether the company has taken any fund, right? And second is whether a company has raised loan during the year on the pledge of securities. So this also need to be checked by the auditor and to be reported. So that the company has taken any fund from any entity or a person on account of to meet obligation. I think the focus is what if I have taken any fund from any entity or person, but the objective is to use a fund not for me, but to use a fund for meeting obligation of subsidiary, associate, or joint venture. So the fund has been taken by the company not for its own purpose, however, for the meeting obligation of SAJ. In that case, that is to be disclosed, that is to be checked, and that is to be provided by the auditor. When the company has raised a loan during the year on the pledge of securities held in subsidiary joint venture associate company, then that also need to be provided and disclosed here in CARO reporting. Cash losses, whether the company has incurred cash losses in the financial year and in the immediately preceding financial year, if so, state the amount of cash loss. So here the object is that first we need to decide what is the cash loss. So from profit after tax, we need to remove all like non-cash items, and then cash loss is there. So if there is a cash loss during the year or in the preceding financial year, then there is a responsibility on the auditor to report that cash losses. Now the few points is on control related, that is on record of intangible assets, inventory verifications, fund related, whistleblower complaints, intra-audit related, audit resolution, and a CFS. So the first point is on intangible assets. Same like property plant equipment, fixed and registry is required. Same way, there's also need to have a register of intangible assets, and there's one of the most important change because intangible assets also need to be appropriately recorded. Then comes inventory physical verification. So earlier also there was a need to talk about the verification of inventory, but now the scope has been expanded. It is saying that it's not only about whether it is appropriate. Now it has been expanded to say that whether coverage and procedure of such verification, whether coverage and procedure of such verification is appropriate or not. I think that is what is the additional responsibility as far as the audit is concerned. We cannot only stop only at the level of reasonable interval, but we also need to look at the additional documentations, that what is the coverage of the verifications, what is the scope of that, whether procedure of verification is correct or not. So that all also need to be commented here. Fraud related obligation, earlier it says that the fraud on the company is restricted only in case of if it is done by officer or employees. Now it has been removed. So if there is a fraud on the company by anybody, it has to be disclosed here. So fraud on the company, irrespective of the officer employee, it has to be provided here. Plus, if any NET 4 form is to be filed regarding fraud reporting by the company, that has to be also explained and commented here in CARO. Whistleblower complaint, if any, then that is to be basically provided by the auditor in CARO reporting. Intra-audit system report. So now there is a responsibility cast upon the auditor that they have to consider separately the reports of intra-auditor. They cannot say that I have not checked. There's a responsibility cast upon the statutory auditor that they need to look at the report of intra-auditor and then they have to comment. And also you have to comment on the intra-audit system. Is it appropriate as per the size and nature of business? Resignation of statutory auditor. So if the statutory auditor resign, it is an additional point for the auditor. If what is the reason of the statutory auditor resigning and whether it has been appropriately dealt with in the books of accounts or not, that is to be commented by the auditor here. Please note that in the CARO, if it is not applicable, the comment of auditor is compulsory. You cannot omit the comment itself. If it is not applicable, it is to mention. If it is not, that is to mention. If it is yes, then you report details. But every comment in CARO is a compulsory. Even though it is not applicable, the writing by the auditor that is not applicable is compulsory. Now, this is one of the very important change, that is with the consolidated financial statements. Now, the CARO reporting is not required in CFS. However, the consolidated auditor also need to consider and provide the listing of qualification or adverse comment. So what is requirement is that there is no need to provide a separate full CARO reporting, but only the listing of the qualification or adverse remarks of the component auditor which they've done, it is to be provided. So it's compilation of qualification or adverse remarks by a component auditor. That means every subsidiary, associate joint ventures, whatever way they have done it, that compilation is to be provided here in consolidated financial statements audit report. Now, just to take last 1 minute on business specific regulations, there are a few changes as far as the Nidhi company is concerned and NBFC and core investment company is concerned, where in with respect to Nidhi company, whether there is a default in payment of interest on deposit or repayment, if any, it has to disclose here. And in case of the conducted by NBFC housing companies, then whether they are having any certificate of registration or not. In case of core investment companies, CIC, so whether they are fulfilling the continue to fulfill the criteria of CIC or not, and if the group has more than one CIC as a part of group, then which are the number of CIC which are part of group. These are the information to be provided as far as this is concerned. So before I take up with the questions which you may have raised during the session, let me just have a brief synopsis summary of what we discussed. The CARO 2020 is one of the biggest change. It is going to increase a lot of responsibility on the auditors. What is required is that there has to be understanding, awareness as far as the CA firm is concerned, CA staff is concerned, and also we need to also educate and aware the management that there is an increased responsibility on the auditor. So there are a few clauses I think which requires attention. Is that one, working capital limited. If wherever there is a more than 5 crore rupees of sanction limit is there, then the statement is submitted by the company to the bank. We need to look at that things. Then the responsibility of the auditor, which is qualitative responsibility of the auditor, to focus on meeting the liabilities. That is what is to be very critical. Use of short-term fund for long-term purposes. Compliance of deep deposits, one of the very, very critical and tricky issue as far as the medium size, small size, large size companies concerned. And inventory verifications, is it appropriate? We also need to look at the procedures, coverage of the verifications, and procedure which is done by the management while doing verifications. So these are the just a few points as far as the number of changes may be concerned. In my view, this will really require a lot of efforts as audit is concerned. And as I discussed earlier, that the government looks at the audit as one of the very critical function. Second very important thing is the audit is serious business. It is not something which can be done only as an additional part, as a part of providing service as a one-stop solution. But this is something which requires a lot of technical understanding of accounting standards, a lot of technical understanding of Companies Act 2013 is concerned, disclosure is concerned, and also a robust understanding of management is concerned, and the training to staff. So this is a big change as far as Schedule 3 is concerned and CARO is concerned. And my humble request to each one of you that let's all need to really increase our level of standard of compliance to ensure that we meet the expectations of the government is concerned as far as this is concerned. Now with this, before I end, I'm asking the coordinator of the this session, if there's any questions, we can deal with the questions.
Thank you, Chintan sir. Yes, there are queries which we have received. First of all, thank you, Chintan sir, for your in-depth and meticulous deliberation on the topic. Your expertise and grip on the topic will surely help the members at large. The first query which we have received is whether renewal of deposits from shareholders, which is done as a book entry, needs to be reported under clause 3, subclause 5.
Can you please repeat again the question?
Yes, sir. Yes, sir. The question is whether renewal of deposit from the shareholder, which is done by the way of book entry, needs to be reported under clause 3, bracket 5.
Let me see clause 3F first, and then we will discuss on that. Clause 3F is on surrender or disclosure of record income. I think that is what your voice, Neerav. Can you please let me? Can you type the? If you have any screen, can you just show me the screen and then I can see it.
I can repeat the question.
Yeah, please. Or you can WhatsApp me. I can see it.
Okay, just a second, sir.
Yeah.
serial number 4 that was whether renewal of deposit from the shareholder done as book entry need to be reported in the cost query.
That's 3.5. Okay, fine. See, basically, renewal of deposit from shareholders done as book entry. I think this again need to understand what do you mean by book entry, because the focus is that redeemed deposit is being included here. Now, if the deposit is renewed, so that means you are saying is if the deposit is renewed, then compliance of section 73 to 76 is required, right? So if anybody can just if they are able to, what I understand from your question is that you are saying there is a deposit which is renewed, so deposit is taken from a shareholder, right? So if you take a deposit from a shareholder, I assume that it was exempted under the deposit section. If it is exempted under deposit section, and if you renewed without repaying the money, it is, that's why you say book entry. So then it is covered, because if something is a deemed deposit and as per the deposit section, if you are required to repay within particular period of time, and if you're not repaid and it is done through book entry, means you're not repaid the money and you just pass entry, and if it's a deemed deposit, then it is covered as a part of this requirement concern.
So the second query is whether the borrowing from the director also included within the limit while calculating applicability of CARO to small companies.
Borrowing from director. So as far as CARO is concerned, basically the CARO, it talks about borrowing. It includes all borrowings. It is not talking about only the deposit. The word which is used is a borrowing, not a deposit. And the loan or borrowing from the director is a borrowing when you disclose in financial statements. So exemption which is there for deposit is on for compliance with section. So the all borrowing, including the borrowing from that, is to be covered for applicable CARO.
Okay. So coming to the next question, it says whether non-deduction of EDS, that is tax deducted as source, on the provision for the expenses be considered as default in payment of statutory dues and to be reported under CARO 2020.
Okay. See, basically, now let me just look at that non-deposit. So here it says undisputed statutory dues. That is to be, there are two provisions. One is that, let me just look at that, whether the company is regularly depositing undisputed statutory dues, including GST, PF, service tax, income tax, that includes TDS also. If not, the extent of areas of outstanding statutory dues as on the last day of the financial year. So if there is a default, you may say there is a company is required to deduct TDS, but company is not deducted TDS. If the company is not deducted TDS, then there is a default. So I think it has to be mentioned, because if you just look at a CARO point of view, CARO talks about the payment of the undisputed money. Now here the point is about which is not deducted at all. So in my view, it is something where which is a critical point, but it should be disclosed better to avoid any kind of issues later on, because the CARO is focusing more on depositing. Here the focus is where it is not deducted, so there is no question of depositing, but there is a default, so it should mention here.
Thank you, sir. The next question is, in case of private limited companies where the passenger vehicles registered in the name of directors, which is duly backed by board resolution, whether the same should be reported?
See, as far as the reporting is concerned, the title deeds are for immobile property. The vehicles are not covered as far as CARO is concerned. The change which is focusing is saying that title deeds of immobile property, and immobile property is defined as a land and building. So other than land and building is not covered as far as CARO is concerned.
So there's other queries which is not related to CARO, but I'll put up to you. It's up to you. So that it says
Okay.
how to check whether any proceedings is going on or not under Benami Act. Is there any site to check based on PAN number, GST, or company identification number?
There is no such site as far as it is concerned, but I think we need to have inquiry with management. We need to have an intentional discussion with management, and as far as possible, if we are unable to really get more comfort on that, management requisition letter also need to be signed with the management. But there has to be, along with MRL, there has to be additional level of inquiry. If you feel there is a suspicious If you are suspicious about this particular thing, then you may go into the more detail. Otherwise, the initial inquiry and the MRL from the company as a document should be sufficient.
Thank you, Chintan sir. That's all the queries we have it for the CARO session. Thank you so much for your valuable time and interpretation and enriching members on the topic of CARO.
Thank you so much,
Thank you,
Nirav. It
Chintan
was
sir.
really a pleasure for me, and I'm thankful to ICF for giving me the opportunity.
Thank you, sir. Now moving to the second session, our learned faculty Abhay Desai sir has already joined us. From CARO to the GST, where demands and recoveries under GST will be taken up by Abhay Desai sir. I request Rushabh Shah if he can please introduce our learned faculty Abhay Desai sir.
Good morning, everyone. Thank you, Nirav, and thank you for giving me a chance to introduce our learned CA Abhay Desai sir. Talking about Abhay Desai sir, I think he needs no introduction, but as a protocol, I need to. So, introducing him, he is a chartered accountant with ranks at various CA examination. He started his practice after qualification with Yagnesh Desai and Company as a partner. He specializes in the field of taxation and renders advisory as well as litigation services up to the level of Honorable Supreme Court to several business entities across India. He is an expert in handling the complex issues in GST. He has a rich experience representing clients across various authorities and the tribunal. He has a deep understanding of not only the tax laws but also the business dynamics as well as technological issues. He has authored several books. His book on the Sabka Vishwas Dispute Resolution Scheme 2019 has been published by the prestigious Chamber of Tax Consultants, Mumbai. He is one of the contributors of the ICAI publications on GST annual return and audit. He has been a co-chair member of the IDT committee of ICAI for the year 2018-19 and 21-22. He is also a member of the Indirect Tax Committee of Chamber of Tax Consultants, Mumbai. He had addressed more than 500 seminars on indirect tax to date. He has presented various papers to various institutes all across India. His treatise on recovery and attachment proceedings under GVAT law has been published in the International Research of Management and Commerce, published by the Associated Asia Research Foundation. He is the winner of the All Gujarat Elocution competition held by the Bar Association. He has been awarded as a best column or paper writer for the Gujarat Silsak Bar Association as well as GST Practitioner Association of Maharashtra. This is just a short profile of what Abhay Desai sir is. Sir, we cannot wait further to listen more from you. Over to you, sir.
Thank you, Rushabh bhai. I request Abhay sir if he can take the charge and take the session ahead.
Yeah, so very warm good afternoon. First and foremost, I am grateful to Shri Purushottam Khandelwal ji for being kind enough to invite me to share some of my thoughts on the topic. Thanks to Nirav ji, Rushabh ji for a kind introduction, office members from the committee, seniors in the profession and friends. It is always a pleasure. Now, in fact, today we have a very interesting topic, so to say. I believe so the whole idea, I think, since we have a limited time, so I thought let us focus on a topic where we can discuss certain core principles that one should keep in mind as a professional while handling litigations or advisory in the context of GST. And let me tell you, friends, the kind of litigation that we are going to see in GST will be huge for the reasons that the law is new. The law is badly drafted. After the law was enacted, we have series of notifications, circulars, which are often contradictory, often violates the provisions of the Act. The rules have been issued. Then we have this authority, what we call it as an authority for advance rulings. They have, in fact, done, in my opinion, a great damage to the entire topic of GST, because the kind of rulings that they have given, a lot of them are really totally not in line with how we understand the law, or how, in fact, the courts have understood the law in the earlier regime. And therefore, I think those advanced rulings, if they are going to be the backbone for the department to carry out their audits and then identify the issues, issue the audit reports. If the taxpayer is not ready to pay up those liabilities, proceed with the show cause notice, adjudicate the show cause notices, and then the taxpayer needs to go to the tribunal, the first appellate authority, then the tribunal. Tribunal also, as you are aware, is yet to be constituted. So we are seeing so much of uncertainties which are lying around the entire topic of demands and recoveries. And therefore, I think that it will be a big professional opportunity for every one of us to really render proper advice, proper guidance to the clients, undertake proper drafting of the replies, undertake the proper filing of the appeals, the grounds to be taken in the appeals, so on and so forth. So today's session, we are going to focus on certain important principles related to the topic of demand recoveries, which I feel are a must for any taxpayer or any tax practitioner to understand and to be aware of while analyzing the notices which are issued by the department. And let me tell you, friends, even a simple notice like a notice to carry out the GST audit by the department under section 65, even in those proceedings, really as a professional, we can add immense value to our client. Let me share one practical example to start with, so as to give the importance of what value we can really add. So very recently, it happened that one of the taxpayer came to us. In fact, he has been subjected to the departmental GST audit, and the department found in their P&L account an income which was reflected as a tooling cost. So this was a taxpayer who was engaged in the business of manufacturing certain components for the foreign clients. To manufacture the components, the taxpayer needed to procure certain tools, molds to carry out that manufacturing process. The cost of those tools or molds was paid by the foreign customer, and that was what was reflected in the P&L account as tooling income. Now, during the audit, the department has raised an issue saying that this tooling income will be liable to GST. It will not be considered as an export of services. Now, the premise of the department is that since the tools have not physically been taken out of India, it will not qualify as an export of goods, because the definition of export under the IGST Act entails taking out of the goods outside India, and only then you can qualify the transaction as an export, and then you can enjoy the benefit of zero rating. Department says that since in this particular situation, the tools have been used in India only by the given taxpayer to manufacture components, and it is the components which have been exported and not the tools. And therefore, the amount received towards the tool value, towards the tooling cost, will have to be liable to tax. Now, this is the factual background. Now, as a professional, what value we can add? So really, when someone looks at the contract in such situations, one may find a possibility where basically the foreign customer is paying this tooling cost not to acquire the ownership of the tools. The foreign company is paying the tooling cost just to secure the production of the components for which the foreign company wants to acquire the ownership. So essentially, this tooling cost is nothing but an additional consideration towards the value of the components that this particular taxpayer is going to manufacture using those tools and export it to the customers. So basically, a stand can be taken that this is nothing but an additional consideration towards the export of components. Department may say that your shipping bill does not reflect this consideration. The counter to that would be that you look at the export valuation rules under the customs law. Unlike the import valuation rules that mandate the loading of such additional consideration to the import value of the goods for the purpose of payment of custom duty, on the export valuation rules do not require the loading of such additional consideration in the shipping bill at the time of export of components. There are also certain judgments in the pre-GST era in a similar context where the courts have held. In fact, in this particular matter, Bombay High Court in the case of Johnson has taken a view that if the ownership of the tools will not be acquired by the customer, then this cost which is paid by the customer is nothing but an additional consideration towards the value of the components that this particular taxpayer apply to that customer. And therefore, this has to be added to the sale price of the components and not to be treated as a separate transaction of sale of tools. So when you look at the contract, when you look at other aspects, you may come to know that the facts are different. Here, what department is saying that you have sold the tool, but the real fact comes out to be otherwise. In fact, you are not selling the tools. You are only getting the tool cost to sell the components that you are going to manufacture using those tools. The ownership of the tools remain with the Indian company, Indian taxpayer. In fact, whenever the tools will be sold as a scrap, the entire scrap amount will be retained by the Indian taxpayer supplier. It will not be that amount will not flow to the foreign customer. So at the time of audit, you can bring all these facets, you can bring all these facts, you can submit those facts. Department may still go ahead and say that we still don't agree, we still think that this is liable to GST. No problem with that. The real value addition comes because since you have given the facts at this stage, and those facts have not been disputed as to what is the real intent behind the transaction, what is the contract behind the transaction, how that contract has to be interpreted. Those aspects, factual aspects which you are submitting now will become a base for you when this kind of matters go into litigation. Because once a fact has been admitted and it has not been disputed by the department at the time of issuing the show cause notice, that is by the original authority, the adjudicating authority and the appellate authority sit only in the judgment of the notices or the orders passed by the lower authority. So the role of adjudicating authority is to decide whether the allegations framed against the taxpayer in the show cause notice are in accordance with law or not. The adjudicating authority cannot travel beyond the show cause notice and try and bring newer facets into the matter, newer facets into the proceedings. So once a fact has been admitted, not disputed, forms the part of show cause notice, then the entire proceeding henceforth, be it an adjudication or be it an appeal, will be surrounded within the four corners of the show cause notice, the facts noted in those show cause notices and the allegations or the law applied by that original authority to justify whatever demand that original authority is proposing to recover. So this is where as a professional we can really add value, where we can really look at the contract, we can really look at the actual transaction, we can submit the real facts so that when these matters go to the adjudication or to the appellate level, those facts, the ground, the framework that you have built, because you understand the law, you understand how ultimately the courts are going to look at this transaction or how the appellate authorities are going to look at this transaction. And basis that, once you create a very strong foundation for that issue, then I feel, and it has also been my experience, that the chances of success that you will have when such kind of issues travel to the higher authorities will be extremely high. So this is to start with why I shared this particular real case, is to help you appreciate that what you are going to do now, be it at the time of the responding to the notices on discrepancies observed by the authorities in your returns filed by the taxpayer, be it the observations noted by the authorities as part of their search proceeding, as part of their audit proceedings, the response that you give and the manner in which you give that response will become very critical when those issues remain unsettled, when those paras remain unsettled, and those cases ultimately go into adjudication. So at that point in time, whatever groundwork that you have built will become extremely important to distinguish your facts, to distinguish your case vis-a-vis some other case that the department might think is applicable to your case, and based on that, perhaps the department goes ahead and issues the notice. So this is extremely important. So agenda would be, we'll look at the fundamentals related to recovery, and we'll look at certain GST provisions and how we can apply those principles that have already been settled by the courts in the past to allow us to frame a proper reply, to allow us to frame a proper response. So when you look at the fundamentals related to the topic, that is demands and recovery, In fact, the Constitution, if you look at Article 265, it makes a distinction between levy and collection. It says, no tax shall be levied or collected except by authority of law. So not only levy of that tax should be based on the authority of law, but even the collection of that tax should be based on the authority of law. Why I am saying this? Because the provisions that we are analyzing today for today's session related to demands and recovery are not part of the levy provision, they are not part of the charging mechanism of the law. They are part of the collection mechanism of the law. However, why this is also important? Because collection also has to happen in accordance with the law, even if levy is sustained. But if the collection has not been made in accordance with the law, if there is a defect in jurisdiction of the officer who is issuing the notice, if there is a defect in the manner in which the notice has been issued, if there is a defect in terms of the limitations within which that notice was supposed to be issued or within which time frame the adjudication was supposed to take place, all such defects cross. If activities would lead to a situation where the collection can be said to be not in accordance with the law, and if it is found that the collection is not in accordance with the law, then that tax which is otherwise leviable still will not be able to be collected because of this aspect. So that is why it is important. In fact, even GST law, if you see section 9(1) of the CGST Act or section 5(1) of the IGST Act, it also embodies the same concept where it says there shall be levied a tax which is CGST in the context of CGST and collected in such manner as may be prescribed. So that also clearly embodies the idea of Article 265 to say that levy and collection both have to be as per the law. Now, the law defines the term assessment in a very broad manner, not that much relevant, because as we understand in GST, any recovery that the government wants to make except the self-assessed liability has to be in accordance with section 73 or 74 in terms of, first, they need to issue a show cause notice, frame the charge against the taxpayer, that what are the grounds on which they are proposing to recover those dues, allow the taxpayer the opportunity to file a defense reply, adjudicate those replies, those submissions, then pass a judicious order, which is again an appealable order, which can then be taken into appeal if that order is not favorable. Even the courts have understood this aspect that levy and collection are both distinct. In fact, we have several Supreme Court decisions where they have reiterated what we already discussed, that collection also needs to be in accordance with the law. If there is any defect in the way in which the tax is collected, that defect will become very vital, and that collection will not succeed if that defect is if there is any contravention of the law. Now, coming to the scheme of the Act, as far as demands and recoveries are concerned, so we have two types of dues for which we need to understand how the scheme of the Act is. In case of self-assessed dues, direct recovery is permissible. No show cause notice is required. It is your self-assessed liability. You have admitted your liability, and if you have not paid that liability, then the department has full right to straight away invoke the recovery provisions under section 79 of the CGST Act in terms of attaching your bank account, taking any money that is lying in that account, passing garnishee orders to your customers, asking them to directly pay the outstanding amount to the department and not to the concerned taxpayer, right to the collector to seize the immovable property and then auction of those property. So these are basically the various means of recovery that are available with the department. Those can be straight away invoked as far as the self-assessed liabilities are concerned. Apart from self-assessed liabilities, no direct recovery is permissible. The principles of natural justice demand, and it is part of the law, that any recovery which is not admitted has to be through a process of law. So it could be done either by way of an assessment, where department may carry out an assessment in certain exceptional situations. So section 61 to 64 deals with those situations related to the assessment, where after an assessment, an order will be passed. In certain situations, that order itself becomes final, and if no appeal is filed by the taxpayer, then the recovery against that order can be undertaken. In certain situations where even after the assessment, still a show cause notice is required, and after the adjudication of the show cause notice, once an order is passed, original order is passed, and if the taxpayer is not going into an appeal, in that situation only the recovery would be permissible. Same with the audit also. Any audit observations that the department may come across, and department has already started the audits, although not with that pace, but slowly, as we understand, as we have seen also, the CBIC manual, audit manual is there available on the CBIC website. If you see that manual, in fact, the idea is to audit 100% of the SSEs in the initial years of GST. We'll see how that will pan out, considering the fact that there are more than 1.5 crore GST taxpayers. But anyway, a substantial number of taxpayers would get audited in times to come, and during those audits, certain issues would be, certain paras would be raised as part of their audit report. Again, at that point in time, no recovery is permissible. If the party is not settling those paras in terms of paying the whatever dues are quantified, in that situation, department still will have to first issue a show cause notice, and thereafter undertake an adjudication, pass an order, and only if the taxpayer is not going to a further appeal and accepting that order, only in that situation, if the taxpayer is not voluntarily depositing the dues as per that order, only in that situation the recovery would be permissible. Similarly, in case of actions in the nature of summons, inspection or search, again, no recovery is possible. No recovery is possible on the date of search. No recovery is possible even immediate after the date of search. Only if taxpayer wants to voluntarily deposit something, he is permitted to do it. Otherwise, issuance of show cause notice and adjudication of that show cause notice is must if the department wants to recover any dues that the department considers to be unpaid. So this is basically the scheme of the act. This has to be understood and kept in mind, because department thinks that once they have identified some issue during the audit or some issue during the search, they feel they have the right to straight away recover any liability against that particular issue. But that is not the law. The law mandates that department will have to issue a show cause notice. Adjudication has to be undertaken, and only after that the recovery is possible if the taxpayer is accepting that order and not filing further appeal. So this is basically the entire scheme of the act. Now, first let us discuss the aspect of self-assessment quickly. So the entire scheme of the GST law is based on the concept of self-assessment. Section 59 of the CGST says that every registered person will have the duty to self-assess the liability and declare that in the return that is going to furnish under Section 39, that as we understand is GSTR 3B. Even Supreme Court in the case of Bharti Airtel recognized that aspect of self-assessment and said that once a self-assessed liability is declared and that liability is discharged in a particular manner by utilizing the cash ledger, subsequently you cannot swap that utilization saying that I wanted to utilize by credit ledger and therefore asking the department to revise that return beyond what the period what is permissible in law and swap the entries and claim the refund of that cash which was paid earlier. That is not possible. Supreme Court says it's a scheme of self-assessment. So whatever you can do, you need to do within the confines of the law. Once you yourself are voluntarily using the cash ledger, you cannot then subsequently turn around and for that same period say that you wanted to utilize the credit ledger and then you can swap the entries. That is not permissible, and that is again the same principle of self-assessment that has been reiterated. Now, how does the taxpayer conduct the self-assessment? The law mandates that taxpayer is supposed to maintain certain records and registers. Chapter 8 of the CGST Act and Chapter 7 of the rules deals with what kind of records, documents that the registered taxpayer is supposed to maintain. So these are the basis for the purpose of conducting the self-assessment. 7512 captures the concept what we discussed earlier, that in case of a self-assessed liability, no show cause notice is required, immediate recovery is permissible. In fact, an explanation has been added recently to this particular section to say that liability declared in GSTR 1 but not included in the return furnished in GSTR 3B would be considered as a self-assessed tax. However, there are exceptions exceptions to this rule that self-assessed tax can be recovered directly without show cause. What are those exceptions? First is clearly a non-admitted tax. When you are not admitting the liability, it cannot be considered to be a self-assessed liability, and therefore that cannot be recovered straight up. In fact, in the past, the Supreme Court has gone to such an extent to say that if a taxpayer agrees to some liability on a piece of paper at the time of departmental audit or departmental search, that liability admitted by the taxpayer by way of a letter is still not the self-assessed liability. Only the liability that he has voluntarily reflected in the return file would be the self-assessed liability. So even in that situation, even if the taxpayer may say that I agree to a liability of so-and-so during the departmental audit, still that does not mean the department can recover that liability immediately. Department will still have to issue a show cause notice, adjudicate that, and only thereafter the recovery is permissible. And that is a sound principle, because many times the department may, under some threat, coercion, undue influence, may try to pressurize the taxpayer to admit certain liability. So he may, at the time of departmental audit or search, on a piece of paper or a letter, he may admit something, but that does not preclude the department from the duty to issue a show cause notice. Even in that situation, the Supreme Court has said that show cause notice is must. And even in that situation, the adjudication will have to be undertaken. So this is very vital, because many times what happens, we see often that certain taxpayers may agree something during the departmental audits, then they come to a professional may look at the issue, and professional may arrive at a conclusion saying that the case is in favor of the taxpayer. The stand taken by the department does not appear to be as per the law. So in that situation, the taxpayer may say that I have already admitted this in so-and-so letter that I have filed. No problem. The taxpayer can then again write another letter saying that whatever I had admitted, that is not self-assessed. I want to agitate on this particular issue. So kindly issue a show cause notice. Whatever amount I have paid, that has to be considered as a deposit. And ultimately, finally, when the final issue gets settled, and if that settles favorably, in that situation, that amount that he had paid would get refunded to that particular taxpayer. So that is the first exception, the non-admitted tax. Something not reflected in the return, voluntarily filed by the taxpayer, is not self-assessed liability. 7512 cannot apply in that situation. Incorrect declaration of liability in 1 or 3B. Now, as you understand, GSTR 1, 3B, people have made some mistakes. There can be genuine reasons for those mistakes. Because of that mistakes, there can be a difference between what is reported in GSTR 1 vis-a-vis what is reflected in GSTR 3B. Still, that would not mean that immediately on the difference, the department can recover. No. It may be possible that that difference could be on account of a genuine mistake. In that situation, the taxpayer has a right to rectify that mistake in the return that he is going to file henceforth. That aspect has already been taken care of by way of instruction number 1 of 2022, where it says that in case of a difference between 1 and 3B, the departmental officer cannot recover that difference. He has to first give a letter, ask reasons for that difference. He has to be given 30 days time to respond, or additional time if the officer permits. Based on that response, he may either clarify the reasons, or he may say that I admit there was a mistake and I will rectify it in the next return that I'm going to file. If that is the situation, then the officer should not resort to recovery. Only in a situation where the officer is not satisfied by the reply, there is a clear admitted liability in GSTR 1 that has not been discharged in GSTR 3B. Only in that situation, the officer can invoke 7512 so as to make direct recovery of that undisputed, admitted, unpaid liability. Interest, again, interest is not automatic. Only the interest, undisputed interest, can be recovered directly in case of an undisputed tax liability. If, let us say, you are disputing the manner of computation of interest, or if, let us say, you are disputing the rate of interest, in all these situations, it is not considered as a self-assessed liability, and therefore, in that situation, direct recovery is not possible. Department will have to issue a show cause notice, consider your submissions, pass an adjudication order, and only thereafter the recovery is possible. Penalty, certainly penalty can never be recovered directly. In fact, 75(12) only talks about tax and the interest on that tax. It does not consider penalty, and that is rightly so, because penalty, the imposition of penalty requires the establishing of the fact that that particular taxpayer had an intention to evade. So that can happen only through an adjudication process. It can never be assumed that if something has not been paid, it is always on account of an intention to evade, and therefore penalty cannot be recovered directly. Any penalty that needs to be recovered, it has to happen through a issuance of show cause notice. So we have all these Supreme Court decisions that is reiterating the same fact that show cause notice is must. Now, this is a power under Section 61 where you would have come across several notices issued by the department in Form ASMT 10, where they find some return difference based on the return that you have filed and ask for justification. You may file the justification in ASMT 11. If the department accepts those justifications, they may issue ASMT 12. If they don't agree with those justifications, can they directly recover that liability? The answer is clear no. In fact, Section 67 itself says that in that situation, the officer will have to either conduct the audit, he can either initiate the audit, he can either go for inspection search if that is the case, or he can issue the show cause notice under 73 or 74. So in a sense, show cause notice under 73 or 74 is must, even in a situation where the officer identifies certain written discrepancies. Now, the burden of proof, this is again something very important principle that has to be understood. In a levy of tax, the burden of proving that the levy exists is always on the department. Once that burden is discharged by the department, then the onus is on the taxpayer to justify that why he did not pay the tax on that particular transaction. This is very fundamental, friends. Many times we have seen department during the audit finds in GST that there is some income in your P&L account and they say that this is liable to GST. That is not sufficient to discharge their burden. If they want to discharge their burden to justify the levy of tax on such income that has been there in the P&L account or some recovery that that particular taxpayer might have made from his employees or from his customers, in any of those situations, the department has to discharge the burden in a way of first identifying where is the supply in this transaction, what is the nature of supply in this transaction, because that is essential for classifying that supply into either supply of goods or supply of services, the HSN or the service accounting code that applies on that particular transaction, then the rate of tax, the valuation of that supply under Section 15, that is, it could be the transaction value, or if there is a transaction with related party, the Rule 28 mechanism. Only once that burden is discharged by the department, then only the question can be posed to the taxpayer to say that in this situation now, show cause as to why this liability should not be recovered from you. So very clearly, if the burden itself is not discharged at the threshold itself, you should take as part of your defense reply a significant and important contention that this notice should not survive on the basis that department has failed to discharge the burden that they are required to discharge in the case of recovering any tax under Section 9(1) or Section 5(1) of the CGST or the IGST Act. So as far as levy is concerned, the burden lies on the state. If the burden is not discharged or inadequately discharged, that becomes a serious flaw in the proceedings, and on that basis, you can contend that those proceedings are bad in law and no recovery is permissible in that situation. However, in terms of exemption and input tax credit, the situation is reverse. In case of an exemption, the burden lies on the taxpayer. If, let us say, you claimed an exemption or you paid tax at a reduced rate of 5% under some notifications. There are several notifications that have been issued where they have granted an exemption beyond the certain rate. For example, in case of a merchant export transaction, there is a rate of 0.1% and there is an exemption of any tax beyond that 0.1%. Similarly, in case of petroleum sector, research sector, we have partial exemption notifications giving a rate of 5%. So in all those situations, there are conditions attached with that notifications that if the taxpayer wants to claim those benefits, he has to comply with those conditions. In that situation, the burden is on the taxpayer. So taxpayer has to first respond when a question is asked to him that on what basis he is entitled for that exemption. Once the taxpayer discharges their burden, then the onus will be on the department to say that in that situation, is there still any failure in fulfilling any of the conditions qua the notification in question. Similarly, in case of input tax credit also, section 155 of the CGST Act itself mandates that the person who is claiming the credit, he is casted the burden to prove that he is eligible for that input tax credit. So this is again very fundamental, friends. I see that lot of notices department is issuing on mismatch with 2A or 2B. Now you may respond saying that in the previous period, that is before January 2022, there was no law which says that credit can be denied based on mismatch with 2B. So you may write this as a reply and you may say that this is enough. Based on that only, you may say to that adjudicating authority that kindly adjudicate the case. Don't get into this manner. You may take that objection, but simultaneously discharge your burden. You produce the copy of invoices, you produce whatever documents you have to establish the genuineness of the transaction, you produce all the available evidences that you have vis-a-vis those transactions in question. Discharge that burden under 155, along with the legal contention to say that on the basis of mismatch, you cannot deny the credit. Why this is important? Because when these issues will travel to the appellate authorities would want to know that on the legal issue, the courts would have settled the issue. But on the factual issue of that particular case, at least if you have discharged that burden, and let me tell you, when you are discharging the burden at this stage, the department is not at all verifying those aspects. They are only blindly going on the difference with 2B. Once they find difference with 2B, they feel that case is watertight, and only on that basis they issue a show cause notice. But against that, you discharge your burden. You produce all the evidences that you have. Those evidences will not be disputed. Once those evidences are not disputed, those evidences become final in law. And once those evidences become final, it becomes a judicial fact because it passes through a judicial scrutiny. Once it becomes an undisputed judicial fact, then at the appellate stage, that authority will not be able to then dispute the facts. The facts are established. Now only law is to be established. And once the law is established, that in a genuine transaction based on mismatch, no credit can be denied, your case will straight away sail through because you have already established the genuineness of a transaction. Law is now established declaring that based on mismatch, no credit can be denied. So you are satisfying both the elements of how the law has been finally laid down. And based on that, you can then get a favorable order from the authority. So that is why it is very important to keep this aspect in mind. Discharge the burden at the first available opportunity in the case of exemption and in the case of input tax credit. Only in case of levy, wait for the department to first discharge their burden and then you respond after considering their allegations as to whether those allegations are in accordance with law or not. Now, when you look at the legal provision, section 73 and 74 deals with the aspect of issuance of show cause notice, adjudication of that notice, and the passing of the order. 73 applies in a situation where there is no fraud, no willful misstatement or suppression of fact to evade the payment of tax. And 74 applies when department alleges that there is a willful misstatement, fraud, or suppression of facts to evade the payment of tax. Now, what happens if, let us say, notice is issued under 74 because mechanically department, and this was the case even in the pre-GST era, that mechanically department thinks every case on in this country involves fraud, and therefore every case is under 74, where extended period of limitation of 5 years would apply and where penalty equal to the tax evaded or input tax credit availed or utilized would become applicable. Now, what happens if, let us say, in that situation, your case actually is not a fraud? In that situation, whether the entire notice will collapse? No. 75(2) takes care of that situation, that if ultimately if it is established that this situation was not involving any fraud, your liability for the normal period of limitation of 3 years will still exist. You will have to fight for that liability on merits of the case. Only the extended liability, the additional 2 years liability, would go away once the case is considered under 73 and not under 74. So this aspect also should be kept in mind, because if the case is extremely weak, And in that situation, one has to be very careful that even if you from 74, you may travel to 73. But even in that situation, your 3 years liability, still you will have to fight it on merits. You will not be able to set aside that liability based on any other reason. So that aspect also has to be understood. Now, what are the factors that the courts have in the past considered? You can find in this presentation that I will share with the committee after the session. There are certain situations where the courts have said that these situations cannot be equated with a situation of fraud or willful misstatement or suppression of facts. What are those situations? Let us quickly go through that. These are important fundamental principles. Bona fide claim. So you have made a claim of input tax credit. You have a basis to say that why this claim is allowable. And the law also is not expressly against you. The law does not expressly debar you from availing that particular credit. In that situation, the claim cannot be said to be made with an intent to evade. That is a bona fide claim. Even if that claim is disputed, extended period cannot be invoked. Recovery for that particular credit has to happen within the normal period of limitation, and no penalty can be imposed if ultimately the department stand is confirmed. Routine errors. Many times GST was new. In 2017, 18, 19, people have committed certain errors, which could be done by an accountant, which could be done by any person. They are part and parcel of when you are handling huge data, huge volume. Certain errors are inevitable. Those errors would not ipso facto mean that this is a case of fraud. No. Courts have said, what is the purpose of audit, departmental audit? In fact, even in the CBIC manual, which has been issued, they say that the purpose is not to recover penalty. Purpose is to find the liability, adjudicate the taxpayer that this is where you went wrong, collect that amount and settle the cases. Only in situation where the taxpayer actively engaged in committing a fraud, only in that situation, the penalty aspect or extended period will come into play. So on that same basis, the same principle was there in the excise audit also. EA 2000 audit manual reiterated the same principle. On that basis, insert number of tribunals have taken a view that any query observed during departmental audit does not mean that that is a case of fraud. No. If they are routine queries, considering the size of the organization, the kind of transactions that the organization deals with, those queries are humanly possible. In that situation, and if the taxpayer is also paying that liability, as soon as he was made aware of that liability, he has discharged that liability. In that situation, it cannot be considered to be a case of fraud. Revenue neutrality, again, something very important. Let us say you have not paid tax under reverse charge mechanism. Today, department finds that that was payable. Can they say it was not paid on account of fraud? No. If the credit was otherwise available to me, even if I had paid in the past, anyway credit was available, no loss was going to happen to the department, to the government revenue. In that situation, the courts have said that in that there is no question of any intention to evade, because what is the benefit that the taxpayer will gain by intending to not pay tax under a reverse charge mechanism for which credit anyway is otherwise eligible. So again, this is a aspect that has to be kept in mind. Reflection of transaction in the accounts. If you have reported certain income in your accounts, now accounts are public documents. You file it with ROC if you are a limited, if you are a company, limited, private limited. You file with other authorities also. In fact, along with 9 and 9C, this was not the case in the earlier regime. In the excise regime, there was no concept of annual return or attaching a balance sheet or financial statements with the annual return. In GST, you are doing that. So the data is known to the department. It is not, it is a different case whether they read or they do not read within the normal limitation period. But data is known to the department. So based on that audited data, if there are entries, part of that audited data, you have reported something in the schedules to the financial statements. Based on that, department is saying there is some liability, there is some income, some nature of claim that is not allowable under the GST. That situation is not a fraud because you already disclosed the transaction in your audited financial statements and you have made available those audited financial statements to the GST department as part of the filing along with your annual return and the reconciliation statement. So in that situation, again, there is no intention to evade and hence 74 cannot be invoked. Positive act is required. Now, what department normally says in a show cause notice after every audit, that this is a scheme of self-assessment. You did not declare that liability and therefore there is a fraud. No. Supreme Court has said that to establish an intention to evade, there should be a positive act done by the taxpayer reflecting that intention to evade. Mere non-disclosure in the return would not be sufficient for the department to say, where otherwise I have already disclosed that transaction in my audited accounts. They are already part of my records. There is a bona fide claim made by me for that particular transaction. In all those situations, unless that positive act is not established, it cannot be said that there is a fraud. Department may say that if we had not done the audit, we would have not known this fact and therefore there is a fraud. No, fraud has to be established in terms of the actions of the taxpayer. Fraud is not contingent on the actions of the department. Department cannot say that because we did the audit, we found something, there is fraud. No. If there is fraud, it is the taxpayer who would have positively done something to commit that fraud. And therefore, the Supreme Court has negated this argument of the department to say that just because we are doing the audit, we have found this out, there is a fraud. That cannot be sufficient to establish the fraud. And second show cause notice. Let us say 17-18 already that period is audited. On a certain issue, department has already issued a show cause notice. They are aware that you are engaged in such business transaction, you are having such kind of claims, you are having such kind of incomes, or you are availing certain kind of credits. Now for 18-19 department, when they come for audit, they cannot say that this is a new information for us. This information, this nature of transactions, my nature of business activity is already known to you. When you did the audit of 17-18, you are now issuing a show cause notice for the subsequent period on the same issue. In that situation, that subsequent show cause notice cannot be said to be, cannot be issued under 74 because this is not a case of fraud. Already you are aware of this issue. And in that situation, it is not the case where I have done some intentional act to avoid that liability. So these are basically the classic cases or situations that you should keep in mind, where whenever department invokes 74, you have to contest that invocation of 74 itself on this grounds. Now, these are all the judgments that you can then refer. Basically, the nutshell we already discussed. These are all the landmark judgments of Supreme Court where whatever we discussed has been already upheld. Now, again, very important aspect, what I discussed initially, that the collection has to be in accordance with the law. Now, law mandates under Rule 142 that along with the show cause notice, a summary of that show cause notice is required to be issued electronically in form DRC-01. Now, what happens when that is not done? Now, in that situation, the collection process initiated by the department is not in accordance with law, because the law mandated the department to issue a summary of the show cause notice in form DRC-01, and that also electronically on the GSTN portal, not manually, not through email, not through WhatsApp. So in that situation, if DRC-01 is not issued electronically, then that proceeding is not in accordance with law. The collection is not in accordance with law, and therefore, in fact, Madhya Pradesh High Court already in the case of Akash Garg has already taken a view that if DRC-01 summary is not uploaded electronically, those proceedings have not been undertaken in accordance with the law, and those proceedings shall not be valid. So these are again the contentions that you must keep in mind whenever you come across a situation where you have to file a reply against a particular notice. Time limit aspect you have to consider. Now, as you are aware, extended period 74, normal limitation 3 years, 73, you are already familiar with that. Now, how does this period work? It works in case other than refund from the due date of filing of annual return for that particular year to which the liability pertains. So, if the liability pertains to 17-18, the due date of filing of the return was 31st January 2020. This was that extended due date. In that situation, the order under 73 has to be passed by 31st January 2023. And the law also mandates that there should be a minimum gap of 3 months between the issuance of notice and the passing of the order. So in any situation, the show cause notice has to be issued on or before 31st October 22. So let us say, take a case where show cause notice is not issued before, is issued in fact after 31st October 22. Can that order be considered to be a valid order? The answer is no, because order might be passed before 31st January 23. But the law also mandates that minimum gap of 3 months should be there between the passing of the order and the issuance of show cause notice. So if that gap is not adhered to, In that situation, those proceedings will not be in accordance with law. For 74, you have extended time of 5 years. So for 17-18, the last date for issuing the show cause notice would be July 24, 2024. And the last date for issuing the adjudication order would be 31st January 2025. Now, this is very important, friends. Now, what happens? Department on a certain issue is into litigation at some stage, in some other case. Now, what this provision says under 7511, it says the time limit that the time that the department spends in that litigation will be excluded for the purpose of calculating the time limit under 74, 73 and 74. However, there is an exception. This condition applies only for the purpose of time limit for passing the order. This does not grant them the extension for issuance of show cause notice. So show cause notice will anyway have to be issued within the dates that we already discussed. So only the passing of the adjudication order can be extended based on the fact that the issue involved is already there somewhere pending in some other case before some tribunal or some high court or the Supreme Court. In that situation, that time limit can be excluded for the purpose of calculating the time limit for passing the order. But this rule applies only for the dates in the context of order, not in the context of show cause notice. So show cause notice cannot be delayed. So department cannot say that since this issue was there pending in the court and ultimately Supreme Court settled it in favor of the department, and therefore now we are issuing a show cause notice for 17-18 recovery. For financial year 17-18 recovery, if the show cause notice is not issued within the dates that we saw in the earlier slide, that recovery is now over. No recovery can be done in that particular year, even if Supreme Court ultimately on that issue holds in favor of the department. Only when the show cause notice is already issued. In that situation, they can then wait. If they want to wait, they can wait. They need not pass the order. Under 74 or 73, they may pass the order after the judgment of Supreme Court. So only the relief can be given for the passing of the order. Relief cannot be given for the passing of the show cause. Now, show cause and voluntary payment, we already discussed. Any payment that you make, unless you are agreeing to settle the case, and please remember, it should be a voluntary agreement. Under 73 and 74, there is a penalty settlement scheme, which says that under 73, if you deposit the tax and interest before show cause notice, the proceeding will abate. Under 74, if you deposit tax and interest before show cause notice, you need to pay 15% penalty and then the proceedings will abate. Similarly, after show cause notice, within 30 days, if you want to settle it under 74, you need to pay additional 25% penalty. That is tax, interest and 25% penalty to settle the case. So that a manner of closing the proceedings is voluntary. Department cannot compel the taxpayer to take those options. So that already issue is settled. Already Madras High Court in GST itself has dealt with that situation, where the statement of the taxpayer during search was recorded, where he admitted some liability, in fact committed to pay that liability over installments. And then immediately when he found out that that liability was not at all payable, he wrote a letter saying that he wants to contest the case. Department said that you cannot contest, you already admitted. The High Court says no. The entire scheme of voluntary closure under 73 or 74 has to be looked at from the context. Only if voluntarily someone is doing that, then only that scheme exists, even after paying whatever amount is stipulated in that scheme. If the department is writing a letter, if the taxpayer is writing a letter to the department and saying that I want to contest, then that entire payment has to be considered as a deposit. Show cause notice is must. If the show cause notice is not issued, the taxpayer has to file a refund claim to get the refund of that deposit that he had made. Now, show cause notice cannot be made on assumptions and presumptions. Already Supreme Court in case of out sugar has dealt beautifully with this aspect. See, in GST, you cannot say that because an AC is there, an air conditioning credit is availed, and AC is installed in an office, but the office could have also been run even without AC, and therefore the credit of AC is not for the purpose of business. That kind of assumptions and presumptions cannot work. What is needed for the business, that the businessman is supposed to decide. Taxpayer, the department is not supposed to decide whether something is relevant for business or required for business. The department is only supposed to verify whether there was any misuse or whether there was any personal use, and only on that basis, based on evidence, department can recover any credit. Department cannot recover any credit based on any assumptions or presumptions. Right of cross-examination. Now, many times department uses a statement of suppliers, statement of transporters to say that they have admitted that this transaction was fake. There was no transport done, there was no supply done, and therefore your credits are ineligible, wrongly availed. Can this be sufficient? No. In fact, Supreme Court in the case of Andaman Timber dealt with this entire aspect and said that if you are going to use any witness statement against a particular assessee, and if the assessee is asking for a cross-examination to verify the truth of that statement, and if you have denied that cross-examination, then any case built on that statement will not be valid in law. That entire demand would not sustain. So please understand that if you come across a situation where in the show cause notice, some statement of is recorded of some other party and use that as a relied upon document to frame a case against the taxpayer, please ask for cross-examination, because that will establish the truth. During the cross-examination, you can ask the transporter that this is the evidence that I am having that you have actually undertaken the transport of goods. Then why in the statement you said that you have not transported the goods? If the transporter during that cross-examination changes his statement and says that yes, that earlier statement was recorded under duress, now I consider that yes, I had done the transportation, and that fact then gets recorded by the adjudicating authority, then his earlier statement gets vacated, and it is the statement given during cross-examination that will now form the basis for deciding the merits of the claim. So this is again something very important. Retraction. Normally the retraction has to be filed at the first available opportunity. You cannot delay the filing of the retraction. You cannot say that today's statement is recorded and after 1 year you will retract. That is not permissible. If today it has been recorded and you find it has been recorded erroneously, disputed facts have been noted and confirmed, immediately at the first available opportunity, file an affidavit. Say that what I recorded was under force, under duress. Ask a copy of that statement. Produce whatever actual evidence you are having to substantiate whatever is the disputed claim, and say that this is the fact, and based on that you now carry out the subsequent proceedings in accordance with law. So this is something which you need to keep in mind. Now, legal heirs. Now, as you understand, during COVID, unfortunately, many people have lost their lives. There could be sole proprietors under GST who might have lost their lives. Can the show cause notice be given to the legal heirs of that sole proprietor and demands can be adjudicated? The clear answer is no. Supreme Court in the case of Sabina Abraham settled that issue, where Justice Nariman said that the assessment or the show cause notice can be issued to a person, and the definition of person includes an individual. It means it should be a living individual. Only where the liability has been assessed when that person was alive, only in that situation the recovery can then be done from the heirs of that deceased person, only to the extent of property that has been passed by the deceased person to that legal heir. So adjudication cannot happen against a legal heir. Only recovery can happen provided adjudication had happened when that particular person was alive. So that is the principle that you should keep in mind if you come across that situation. Erroneous refunds. Now, refund stands on a different footing. The 5-year time limitation under 74 to recover the erroneous refund starts from the date of the refund, grant of the refund, and not from the due date of the annual return to that particular year. So that aspect must be kept in mind. Pre-show cause consultation. Now, this is something again in the excise era, the courts have taken a view that pre-show cause consultation is must. If the pre-show cause consultation has not happened, which was required under law, in that situation, those proceedings are bad in law. In fact, in GST, when the GST law was introduced, there was a mandatory requirement of pre-show cause consultation without any monetary limits. It is only with effect from 15th October 2020 that the Rule 142 Sub-Rule 1A was changed, and instead of shall, it became may. So only thereafter, for the period after this, it is discretionary for the officer to grant a pre-show cause consultation. For the period before that, it is mandatory. So any show cause notice issued before this date should have also covered should have also initiated the pre-show cause consultation. If that has not been done, that will be a ground to take to say that those proceedings are not in accordance with law. Three hearings have to be granted. Then only an ex parte order can be passed. Here again, the courts have settled saying that one hearing notice giving 3 available dates and asking the taxpayer to choose any of the 3 dates would not mean 3 opportunities have been granted. Only one opportunity has been granted. So if the taxpayer does not appear at any of those 3 dates, only one opportunity gets exhausted. Department will still have to issue another notice calling for a hearing, again granting some another date. And only after the 3rd notice that the case can be decided based on the available record. Now, this is again very important, friends. Order cannot travel beyond show cause notice. Series of decisions, Ballarpur Industries, Toyo Engineering, the courts have settled. See, in GST, what happens? They issue a show cause notice on a certain premise, on a certain law. When you respond to that saying that these facts do not warrant application of that law, the adjudicating authority changes the provision and says that fine, in show cause notice, our allegation was that credit is not denied, credit is denied based on mismatch. You respond by saying that there is no provision in law which enables you to deny credit on mismatch. Fine. Now in the adjudication, we are saying since that vendor has not paid the tax, we are denying the credit. Now that is altogether a different ground. Show cause notice never alleged non-payment by the vendor. Show cause notice merely alleged mismatch for which there is no legal basis. So adjudicating authority now cannot expand the scope of show cause notice and bring another charges or another facts into the case which was not recorded and not reflected in the show cause notice. So this is again very fundamental. If you find that adjudicating authority is traveling beyond the show cause notice on that ground itself, you have to take the ground before the appellate authorities without fail. Contents of the order cannot be cryptic order. They have to be reasoned order. Order cannot just say that there is some judgment and you do not find it applicable. That is not sufficient. You should respond. The adjudicating authority has to differentiate the judgment. They have to say why the judgment is not applicable in your facts, and then that is how he has to deal with that submissions. He cannot just simply be subjective to say that I do not find that judgment applicable to that particular case. Order against decided case clause, one particular issue is settled by a jurisdictional high court, and if there is no stay by the Supreme Court and that judgment is not reversed by the Supreme Court, the decision of jurisdictional high court is binding. Similarly, decision of jurisdictional tribunal is binding on the lower authority. So that aspect is already upheld in the case of Kamalakshmi Finance. So if the officer is not following the jurisdictional tribunal or jurisdictional high court decision, in that situation, it is a contempt of that authority. And in that situation, that again will be a ground to take to say that he has refrained and he has not followed the applicable jurisdictional decision. Double penalty. Normally, we have seen in show cause notice, they are saying that you committed several offenses under section 122. You did not charge GST on certain supply. You did not issue the invoice. You evaded the payment of tax, and therefore 3 times penalties proposed of the tax involved. Can that penalty sustain? No. 75(13) takes care of that situation. It says once a penalty is imposed under 73 or 74 for that same act, you cannot impose another penalty under 122. So this aspect has to be understood and kept in mind while responding to the notice. Similar to what we saw earlier, there is a manner of issuing the notice. There is a manner of issuing the order. Again, here the summary of that order in form DRC 07 has to be mandatorily given electronically through GSTN portal. If that is not the case, let us say in many times we have come across situation where manual orders have been given. Time limit for filing the appeal is over. But DRC 07 electronically has not been given. In Gujarat, jurisdictional high court has taken a view that if DRC 07 is uploaded later, then that is the date from which the 3 months time limit for filing the appeal would start and not the date on which you have received the order. So on that basis, if DRC 07 has not been uploaded, you can write a letter to the department saying that this is not uploaded, please upload. Once that is uploaded and then if you file the appeal, that appeal would be within the time, that appeal would not be time barred in that situation. This is the settlement scheme that already we have discussed. When to go for that scheme? please understand it requires wisdom to decide when you want to settle an issue or when you want to contest. You need to see the total context. You cannot just base your case just on technical grounds. You need to see the context in which the dispute has arisen. If you have technical grounds and if you want to contest, you also consider the merits of the case. And once you reach a conclusion that yes, based on both the examination of the facts, disputed facts, undisputed facts, the law, the judicial view, the quantum of dispute involved, the kind of the nature of taxpayer in terms of, because many taxpayers are emotionally sensitive, whether they like dispute, they may not like dispute, we don't know. So all those psychological aspects also needs to be considered, taken into account to decide whether you want to close the case by paying the tax interest and stipulated penalty within the due dates specified in 73 and 74 to close the proceeding or to continue the proceeding. In any situation, even if you close the proceedings are involving an offense under 132, which entails punishment. Those prosecution actions would still be permitted. Those prosecution actions will not abate merely because you settle the case under 74 by paying the tax interest and penalty. So that aspect also should be kept in mind in a situation where the transaction involves fake credits, where department might also invoke 132 in future to launch prosecution against that particular taxpayer. The last aspect of jurisdiction, please understand three important facets are there to a jurisdiction. One is the functional jurisdiction, whether the authority who has issued the notice under 61, 73, 74, ADT 1, whether that authority has the functional jurisdiction to perform that function. Let us say there is an inspector who is issuing a notice, a show cause notice under 73, 74. Whether the inspector has been vested with the power to issue a notice under 73 or 74 is first question that you must ask. Circular number 3 will tell you that answer. If you find that that inspector does not have functional jurisdiction to issue a notice, then on that threshold itself, the notice cannot sustain. Then there is territorial jurisdiction. There is a territory assigned to the different officers of the particular range. You need to see whether that officer who is issuing a notice, whether he has a territorial jurisdiction over you. That is notification 2/2017 deals with those aspects. Then there is a center state issue. That if, let us say, on one aspect, already the center has initiated search in the past and that proceedings are going on. Now, on that same issue, the state during their GST audit cannot take that same issue. Why? Section 6 says that once a particular issue has been initiated by any of the two governments, the other government cannot step in and start the duplicate proceedings, start dual proceedings on that same issue. And that is reasonable also. Once, let us say, on some issue, let us say there is an issue of fake credit. On that issue, already center has initiated search and those proceedings are going on. Now, that same fake credit cannot then be again disputed by the state authorities as part of their routine departmental audit to say that we are also going to issue a show cause notice saying that those credits are not eligible. It will result into parallel proceedings on that same issue, and that is not what Section 6 permits. And therefore, this aspect also has to be kept in mind, that you do not keep on answering the same question to multiple authorities. Once one authority has started that issue, it is that authority only who has the jurisdiction to resolve that issue. Another authority under any provisions of the Act cannot take that same issue for that particular time period. So these are the three aspects of jurisdiction that you must keep in mind. So with that, I end. Friends, I see GST as a big opportunity, immense opportunity for all the professionals. Please, I would request study all the settled principles. My opinion, all those principles of the pre-GST era are equally applicable in GST. And that is where really you will gain enough knowledge, you will broaden your knowledge to be in a position to really respond well to the notices that the clients will bring across to you. So with that, I again thank the committee, Niravji. If there are any questions, I'll address those.
There are lots of queries which we have received on GST part. Many of them is not, I can say, related to demands and query, but they are queries in general. I leave the forum open to you, sir, to discuss or not to discuss. Let's start with query one by one, sir. It says that State GST Department is demanding GST in respect of mismatch of ITC claimed with 2B for the financial year 2017-18 in the proceedings of GST ASMT 10 for FY 18-19. How to defend the same?
So basically, as I said, first you need to establish the genuineness of the transaction. So please produce whatever evidence you have, inventory records, the transportation proof, the invoice, the payment to the vendor to substantiate your case that this transaction is genuine. Second, if possible, if you can take the affidavit from the vendor saying that he has deposited the tax, that will also help you a lot. In fact, you can also refer to the CBIC manual. In fact, CBIC, when they came out with the audit manual, in para 5 of that audit manual, they have specifically said that in case of a mismatch in ITC, the officer, it is the duty of the officer to communicate with the jurisdictional officer of your supplier, of your vendor, and confirm from that officer whether that vendor had deposited the tax or not. Only in a situation where the vendor has not deposited the tax, only in that situation this officer can issue a show cause notice. So that aspect also you can cover in your reply, saying that kindly, because they have the authority to reach their counterpart in another jurisdiction, take the confirmation of actual payment, and if the confirmation comes that yes, the tax was already paid, then I think then credit we cannot be denied based on mismatch.
So there is another query which what is the difference between audit and assessment by the department, and can the audit and assessment can be done simultaneously?
No, so basically the entire framework of GST is based on the excise law, where in all general situations, it will always be a show cause notice that will be issued and then the adjudication will happen. Only in certain exceptional situations, we have the power of assessment, where let us say someone is not filing the return, where someone is not registered, but otherwise he was required to register, where department apprehends that till the time we issue a show cause notice and adjudicate the case, that person may become Vijay Mallya and he may go away from the country, he may leave the country, and therefore department wants to undertake a protective assessment under 64. So only in those exceptional situations an assessment can happen, not otherwise. So if there is a taxpayer who is already registered filing the returns, then any issue that the department comes across where they want to recover, they have to do it only by following the procedure under 73 or 74.
So there is another query which says the slump sale took place in the end of the year. While filing the GST monthly return, it was not included and the return was filed. Is it possible to file in the annual return form 9 by including the same as exempted turnover for the concerned month?
So annual return is precisely for that purpose, that if you miss something reporting in the monthly returns, you can report it in the annual return, so that at the end of the year, when the department will carry out the reconciliation and try to find out whether there are any gaps or there are any liabilities, annual return would be the first document that would be taken as a base. So if you have missed something, you can certainly report it in, and you should ideally do also. In fact, if you have missed something in the monthly return, so that your annual return covers the all the facts.
So the second query is that self-assessed tax does not include interest if the taxpayer's legal basis to justify that the non-payment. DRC 07 was issued to the client and there was daily calls from the STO for the payment of the said amount. A reply was also given which was not considered. In this scenario, how to proceed?
See, if DRC 07 is issued, basically DRC 07 is the summary of the adjudication order. It means adjudication order has already been passed. So you need to file an appeal against the adjudication order, disputing the claim of interest.
Second query is that ASMT 10 is issued and response also provided by the taxpayer. However, instead of issuing ASMT 12 for the accepted explanation, department has issued show cause notice for some other point, which was not communicated in ASMT 10. Is the action valid?
Yeah, see, basically show cause notice is the start of any adjudication process. In a show cause notice, whatever facts or whatever charge that the department wants to propose against you, that can emanate out of the information that the department may collect under any of the proceedings in law. So you will not be able to defend the show cause notice by merely saying that since this was not specifically asked and now used against you, now department is prevented from using it against you. No, show cause notice is giving you that opportunity. So once you file the defense reply, make your submissions, it is only thereafter that the adjudication order will be passed. So show cause notice is not the final word.
So there's another query which says the department has blocked ITC of the party in the year 2020 without giving any notice for an amount of 30 lakhs. Now in the month of April 2022, the department has unblocked the amount. Can we demand interest on this amount from the department?
There are no statutory provisions where you can demand any interest on the block credits.
The DRC 07 pertaining to FY 17-18 with respect to ITC mismatch between GSTR 2 and GSTR 9. The registered taxpayer have paid the taxes to the respective vendors, but vendors have paid the same to the government. Can we take a stand saying that the onus of tax lies on the vendor and not on the registered taxpayer?
Yes, certainly so. So that is what I was discussing. That establish that transaction is genuine, and then you can certainly expect the courts to rule in your favor, saying that if the transaction is genuine and you have paid the tax to the vendor, then the collection has to happen only from vendor. That is why what I said earlier, that CBIC audit manual also says that in that situation, first the officer of that vendor should try to collect the tax from that vendor. Only if there is any failure, then perhaps the officer here can issue a show cause notice. But even in that situation, I would take a view that in a genuine transaction, even if the vendor has not paid the tax, no liability can be imposed on the person who has availed the credit.
So there is query that ITC is availed in FY 17-18, but his output is exempt. The assessee is in the business of sale of wind energy. He has not reversed the same till September 2021. In September 2021, he received a call and department asked him to reverse the same. Hence, he has reversed the same in 2021, but now department has made assessment and levied interest till September 2021.
So see, basically, if you see in the Finance Act 2022, already Section 50, subsection 3 has been retrospectively amended with effect from 1st July 2017 to say that interest liability at the rate of 18% in the context of ITC will apply only in a situation where you have utilized the erroneously availed credits. So in a situation where you have not utilized these credits, if those credits were part of the credit ledger right along the entire period, then there is no question of any interest liability on this reversal. So based on that, you can respond to the department.
So the SSC is in the business of manufacturing samples and has to charge sample development cost from the foreign customer. So the question is how to charge the same, with GST or without GST?
See, one has to look at the contract. So what is basically why the customer is paying this amount? As I said earlier in that example of tooling cost, the purpose has to be understood. If the purpose is to not assume the ownership, the purpose is to basically achieve something else, then the nature of that supply would be based on that purpose. So once you identify the nature of supply, then you need to identify the place of supply. If the place of supply is outside India, you are receiving foreign currency, then it should qualify as an export. If the place of supply happens to be in India, then the export benefit will be denied, and in that situation, the GST would apply.
Thank you so much, sir. There is a last question which says an education institute has claimed exemption on their course fees. The housekeeping contractor has not charged service tax to the such education institute on the basis of notification. However, department has rejected the contractor's claim and asked them to make the payment of service tax on all the invoices raised by the contractor.
So that again, see, basically one has to look at that exemption entry. Services provided by an educational institution to student, faculty and staff is exempt. But services provided to an educational institution has a qualification. Housekeeping services is covered, but that educational institution should be the one who is providing these services up to the higher secondary education. So one has to look at the nature of the educational institution in question and then decide whether the claim of exemption can be defended or not.
So there is one more question in the script, sir. While discharging statutory functions, certain fees are levied compulsory as mandated by the law. Whether such activities come within the ambit of services as provided in GST law.
See, again, this is I think a large topic to deal with, but let me tell you the summary of this, how we understand. See, basically the entire concept of whether statutory function is a service or not is something which is right now under debate and discussion across various courts. We look at it in this manner that that the concept of supply is broad enough, and the definition of consideration, the way it is there under clause 30 of section 2 says any payment in response to a transaction is considered as a consideration. So where against a statutory payment, if you are receiving any benefit which is only available to you in that particular context, then those fees, unless it is exempt, would be liable to GST. So as an example, license fee, registration fee, there is already an exemption available in the exemption notification. Up to 5,000, there is a blanket exemption available. So if those exemptions are available, you can avail those exemptions. If they are not available, and if you are receiving any benefit against the payment of those fees, then in my opinion, the better view would be to pay and take the credit under reverse charge rather than to rely on the fact that since there is a statutory function, there is no service and therefore there is no liability. I think that would be too risky. Better that if, yes, like for example, taxes. Now taxes are not liable to tax. Income, you cannot say that again under income tax I have to pay GST under reverse charge. Because you are not getting anything. There is no quid pro quo against that taxes specifically for you. But if you are paying something specifically for giving some permit to you, for example, you need some permit to do some business related construction or business related activity, and for that, if you are making some payment and if that is not covered under the exemption, that is a benefit you deserve for the payment that you made. So there is a supply, there is a consideration, there is no exemption in law. Better would be pay tax under reverse charge because government services are under reverse charge. Avail that credit. That would be a better view than to risk and exposure.
Thank you, Abhay sir, for your wonderful deliberation. I'm sure the members at large have got the satisfactory reply to all their queries which they have posted to us. We have Chintan Patel sir, you have rejoined us. Sir, there are few queries which we have skipped. If you are convenient, we would like to take them, sir, with your kind permission. Chintan sir.
Sure, Neera, please go ahead.
Yes, sir. Sir, the query says when we are talking about working capital exceeding 5 crores, will it include fund-based and non-fund based or simply fund-based working capital?
Yeah, ICAI has given a guidance note, and if you just look at the guidance note, this particular point has been clarified, which means that both is covered. As far as the loan is taken based on a security of current assets, either is a fund-based or non-fund, both need to be considered.
Thank you, sir. There is another question which says the working capital limit are sanctioned for 1 year and renewed every year based on addition of funds. So it should include renewal as well.
Yes, I think that the same point we discussed when I was talking presentation that yes, it includes renewal also. So whether it's a fresh loan issued or it's a renewal, they both aspects are covered.
Thank you, sir. Sir, there is another query which says in case of private limited company where quarterly returns are not prepared, how we will verify the same with the stock statement submitted? Yeah,
so again, I think the point was taken that if the quarterly return is not submitted and if you are submitting a monthly returns, so for example, if you are submitting April month statement, May, June, July, August, so in that case, the quarter end is June. So even though for June month, you are submitting June month statement, not a full quarter, but that June month statement you do cross verify with books of accounts to see that is it in compliance or not.
That many banks have sanctioned COVID-19 loans and also company has taken the same, but the use of the repayment of old loans, whether it is necessary to report under clause 3(e).
The point which is critical here is that if any loan is been taken for settlement of existing loan, it is covered. So if you mention that the COVID-19 loan is already there or some other loan is there, but the objective of that particular loan is to settle existing falling due loan, then it is covered, otherwise not.
So is there methodology or procedure for checking the usage of short-term loan fund for the long-term purposes?
It is more of like analysis based on the balance sheet. Fund flow analysis is what is required. So there are a few means where you can look at the fund flow analysis. You can look at if there is a direct relationship available between the fund when you receive fund and when you give the fund. If you are able to establish a direct relationship, that is okay. Otherwise, you can also have other mechanism where you can look at long-term fund application. If the long-term fund application is 100 rupees, for example, and your long-term fund receipt is 120, then no issues, because long-term fund receipt is more than long-term fund application. But in case if your long-term fund application is 100 and long-term fund received is 80, that means there is a possibility that the short-term fund has been used for long-term. So that kind of long-term, short-term application can be done.
Thank you, Chintan sir. There's one last question which says that in case of manufacturing company, finished stock valued on sale rate instead of cost of production value, and at the time of finalization of books quarterly or annually, finished stock valued at cost of production method and variance find out both in value of stock. Are we supposed to report the same?
Yes. So basically, the clause says that you need to reconcile books of accounts stock figure with the stock statement submitted to the bank. Now, as you mentioned that the books of accounts has a different valuation methodology, and the stock statement which is submitted to the bank has a different valuation methodology. So there is a difference. So in case there is a difference, we need to report. Yes, we need to report, because the clause says you have to compare, and if difference you have to report. But then there is another requirement which says reason for discrepancy. So in a reason for discrepancies, you can explain that because of the valuation methodology which is different, and there's a reason. However, they both are in match. So this kind of reason you can provide it, but you need to report it.
Thank you so much, sir. Chintan sir, Abhay sir, thank you so much for your wonderful deliberation and enriching members at large. I'm sure that all the members who have come with their queries have got their answers. And we know, sir, both of them are always available for the members. They can easily approach you for their queries in case they have. Thank you so much, sir, for enlightening us with your words of wisdom and with your rich expertise in the respective subjects. Thank you, sir. Thank you.
Thank you so much. Thank you, Chintan bhai.
Thank you. Bye-bye. It's always a pleasure to have with you.
It's always a pleasure. We always learn something new from you.
Both way.
Thank you. Thank you.
Yeah.
Thank you.